Welcome back to Squawk Box this morning. We are live at the 9th annual Delivering Alpha Investor Summit in New York at the Pear Hotel. We are here to bring you interviews with some big influential names in politics and economics and some of the best investing ideas from some of the smartest asset managers in the country. And doing that right now, joining us on set is David Villa. He is the Executive Director and CIO of the State of Wisconsin Investment Board. David is also on our Delivering Alpha Advisory Board, and we're thrilled to have you on the set with us.
Thank you very much. Happy to be here.
So here's my question. Given where interest rates are and what Jay Powell is doing, and given where what seems like slow growth everywhere else in the world, if you're a pension fund in America today, what is the rate of return that you think is fair and reasonable to expect and to promise pensioners?
About 6%.
6%. And do you think that's the fair number for that over the next decade, or is that today? Is that over a decade, 2 decades? What is that number for most people right now?
5 to 7 years.
5 to 7 years.
Yeah, it might be 7% over 30 years.
But that's actually interesting. That's a little higher than I would have even expected, given how low interest rates are. How do you do that? Where do you go to find returns like that when we're talking about the Fed continuing to lower interest rates?
Yeah, you need a big dose of private equity, private real estate, private debt, a lot of alpha, a lot of excess return.
Yeah.
Otherwise, you're going to be 5.
Yeah.
So in terms of how you have reallocated the fund, you talk about private equity and other alternative assets. Sort of what does it look like if we were to do a chart of your fund right now in terms of where the money is being directed?
It's about 55% equities and 45% fixed income.
And within the equity component, I'm assuming then there's a private equity component of that, or no?
Yes.
Okay. And what chunk would you have in private equity? What chunk would you have in sort of early stage venture, late stage? I mean, give us a little bit of a breakdown, because I think there's a lot of our viewers who are even thinking about their own portfolio, and to the extent that you've had some success, I think they're trying to model that.
Yeah. Well, for private equity, if you consider the hurdle or the benchmark to be public equity, you need to earn more than public equity. And if you don't pick the top quartile fund, you're going to earn less than public equity. So it's not worth the squeeze if you can't pick the very best managers. And that's very hard to do. And so the very best managers are rare and they're expensive. So we're only able to put about 6% of the fund into private equity because of the supply of good managers. For private debt, we have about 1.5% of the fund in private debt.
What do you say to the sort of Warren Buffetts of the world who say actually that active investing is sort of a fool's errand for most people?
Well, I think it has been for several years, but today I think it's more like the opportunity of a lifetime. So I would say fine.
Why is that? You think the averages have kind of peaked at this point, and that the only way to really ride things higher is going to be individually choosing things, or because you think at this point it's just time for some of the active investors to kind of have their day?
Well, I think there's probably 2 things. One is the market has had very low breadth. So only a few names are driving the market. Mm-hmm. There's a lot of potential relative value in the market, and there's been a lot of capital that's moved out of active management into passive management. So that forces active managers to sell what they like and indexes to buy what the active managers don't like.
That's interesting. We just said yesterday that for the first time ever, passive funds have outpaced actively managed ones, just in terms of how much money is funded into it.
We moved about $6 billion into active management this year, and we're very happy with the outcome.
Yeah.
What kind of negotiation are you having right now on fees? Because that's always a big issue right here at this very conference, given that there are so many asset managers trying to collect fees, frankly.
Yeah, well, we would rather not pay fees.
As I would imagine.
But I think if you're looking for skill and you're trying to get that excess return, as long as we keep about 60% of the juice, we're happy.
60% of the juice?
Yeah, 60% of the value added that's created, because they're using our capital.
Right.
So they're kind of renting our capital to generate their fees or their return. especially when it's for performance fees or carry.
Right. Okay. David, it's great to see you. We appreciate you being here.
Thank you.